From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield, the 1 hour edition, starts right now. The Iran war upends the energy market, sending global bond yields surging. Investors rush to bet on higher interest rates after major central banks, including the Fed, signal fresh concern of an inflation shock. And the volatility leaves banks scrambling to set realistic prices on billions of dollars of buyout debt. We begin with the big issue, an economy clouded by the fog of war.
Just like investors aren't really sure about how to respond to this, it certainly seems like that the same from the central banks.
They decided to just basically completely ignore the Middle Eastern shock that we're facing here.
And they're basically saying all of this going on in the Middle East is a speed bump.
There are short-term impacts, but there are also longer-term impacts that these central bankers have to consider.
There's not a huge amount of forecast accuracy here.
Markets definitely have priced out the Fed easing.
You can't hit the global economy with a shock of that magnitude and not expect bad things to happen.
The longer this conflict, continues, the worse it will get for economic growth.
Markets are repricing the front end pretty aggressively.
The areas where a tremendous amount of value has been created in the bond market is in the front end of developed market curves.
We have an economy that faces growth as well as inflation risks.
The risk of recession is higher than the markets believe.
And following the Fed decision to keep rates unchanged and Chair Jay Powell's news conference, where he indicated the Fed's in no rush to cut rates, traders have now priced out any easing for the rest of this year versus the 2 quarter-point cuts they expected before the war began. Now, in our chart of the week, you can see that the next rate cut would not be until the end of the third quarter of 2027. But look at December of this year, right here. You can see pricing of plus 11 basis points. That shows traders see almost 50% odds of a quarter-point rate hike by the end of 2026. Now, sticking with the central bank, Fed Chair Jay Powell is holding off on forecasting how the Iran war will impact this economy.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. The forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut. This is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know.
Bloomberg's international economics and policy correspondent Michael McKee joins us now with more, with a chart in hand. So, Mike, you were in Washington. It seemed, at least before the Iran war, that this would be kind of a ho-hum meeting. It was far from that.
Yeah, we got certainly a definitive statement from Jay Powell about what his future plans are, which everybody has been waiting for. And then we heard him basically take a very cautious attitude towards what's going to happen in the future because they really don't know. And I think it was almost a sort of a humble performance in that they had done transitory once before, so they're not going to do that again. The basic laws of economics tell you it should be transitory, but just in case, they're on watch. He did say they had discussed the idea of a two-sided risk to the economy, but nobody was predicting a rate cut. But that's what the markets took away. The chart I brought here today shows the 2-year note yield has now poked its head above the Fed funds rate, which is telling you the markets think that interest rates are going to go up. Now, are they going to be driven up? That's what we're going to have to wait and see because the Fed isn't going to meet again until the end of April. But in the meantime, we are seeing higher rates as people price in more risk from the Iran war and everything else that's going on.
Yeah, the 2-year yield and the 10-year yield are now at their highest since July of last year. So that's something to certainly keep in mind. And it raises all kinds of questions for companies that perhaps need to refinance as well. When it comes to the Fed, did Powell say that the FOMC remains data dependent? Because in the best of times, data is backwards looking, and we're really not going to be able to factor in how the rise in oil prices affects data and what the Fed does next.
Well, he didn't say data dependent. He didn't use those words, data dependent. But what he did say is for them to resume the cutting cycle, what they would have to see is the PCE, and particularly the PCE core, come down about halfway to 2% because they figure there are about 50 basis points in there because of the war premium and the tariffs. And if it comes back down there, that you take out those two things and then they feel like they're making progress again. So he does give us something of a roadmap. But as you can see from the way the markets are pricing right now, they don't think we're going to get either one of those things very quickly. You mentioned December. Here's a chart I brought that shows the change in view. And right there where it goes from red to green is where the Fed meeting was. And right after the Fed meeting, everybody decided, well, maybe there's a bigger chance that the Fed will do a rate increase. And right now we've come back down a little bit. There's about a 44% chance.
But it's there.
But it's there. We were up to 50% earlier today, as you can see. So people have taken it seriously. And the longer this goes, the more risk there's going to be in the markets. And so people want to get paid for risk.
All right, Michael McKee, our Bloomberg's international economics and policy correspondent. We're going to dig into all of this with our macro roundtable now. George Bory is chief investment strategist of fixed income at Allspring Global Investments. And I'm pleased to welcome back Kathy Jones, chief fixed income strategist for the Schwab Center for Financial Research. Kathy, let me start with you. I want to pick up on that chart that Mike just showed us, that idea that traders have not only priced out rate cuts for the rest of this year, but they have priced in a rate hike, or the odds of a rate hike this year as well. Is this dramatic repricing appropriate, or is it overdone?
You know, I think it's appropriate because coming into this, the idea was it was going to be a short-term event and we were going to just pass right through it. Now we're into the fourth week, I think?
End of the third week, I believe.
Third week,
yeah,
okay. So we're approaching the fourth week, and that's significantly longer, and it's gotten significantly more escalated than had been anticipated. So we're seeing the energy price shock. And sort of between the rise in energy prices and the slowdown in growth that will come from that is the inflation hit. And so I think the market is reflecting that the inflation hit is coming and it needs to deal with that. I'm not sure that it's accurate that the Fed's going to hike rates anytime soon, but I think it's more appropriate to go from building in one or two rate cuts to being at least neutral at this stage.
George, what do you think?
Yeah, I think that the market has a tendency to overshoot at the very front end of the curve. I mean, just listening to what Mike said and what Kathy said, as well as some of the things Powell said earlier this week, the Fed's kind of on hold. And I think they said that very clearly they're on hold. They're going to wait and see. They cannot move proactively unless something really, really dramatic happens. But as it stands now, they're kind of stuck in neutral. Now, the market's kind of rushed to price rate hikes, which seems a little premature, because if we look a little further out the curve, if you look at break-even rates for inflation 1 year out, the inflation looks like it's going up over the next 12 months. But if we look further out, say 10 years, the market still has inflation pegged at around a little under 2.4%. So long-term inflation expectations remain pretty firmly anchored. But it's those front end, kind of worries that are getting the market very anxious. And when we looked at rate cut expectations earlier last year and even the prior year, the market gets very excited very quickly, rushes to price in rapid moves by the Fed, and then the Fed has to slow pedal and kind of move much more slowly with the data as the data unfolds. So we don't see them doing anything for at least the next 3+ months, or maybe even longer.
So one of the consensus trades before the war began was the steepening yield curve. And this week, we've seen the 2s10 spread narrow sharply to around 42 basis points. You would think that the inflationary impact of rising oil would lead to curve steepening. What does this rapid flattening, Kathy, tell us about what the market sees as the key risks facing the Fed?
Yeah, I think this is reflecting that rush at the short end to price in a shift in rate expectations, at least take out the rate cuts on the part of the Fed, as George indicated. So I think the long-term trend is probably still towards steepening, but there is a chance in one scenario, and there's so many scenarios to play out, but one scenario is this continues, inflation becomes a big concern, the Fed does have to tighten, growth slows down. So we know that behind the inflation push is probably a growth slowdown. So I think the market's starting to reflect that right now. But it'll probably play out these scenarios a dozen times before we actually know, what the end game is here.
George, as we wait for the end game, what do you want to hold? Where do you want to be on the curve?
Yeah, as we pointed out earlier, kind of the big move in the front end is where the action's at, and the value is starting to emerge. Both in the short to intermediate part of the curve, the 2 to 5 year part of the curve is starting to look fairly attractive as the market gets excited and starts to price in rate cuts. Rate hikes. And as Kathy said, as the long end comes down, higher rates and higher oil prices do ultimately become a tax on growth. And the long end is starting to sniff that out, but we're not quite there yet. And so, right now, short to intermediate duration looks pretty attractive. Kind of grab the yield, play the carry, wait for the trade. Once we see maybe a little bit of economic slowdown, that's when you extend out the curve.
When investors fret about oil and inflation, the comparison is always the 1970s. That's kind of where they go to. And when they fear credit blowups, the comparison is 2008, Kathy. Not everything is so extreme, though. I mean, those are pretty extreme examples. What kind of risk does that create, that tendency to go to the most extreme example?
Well, it creates risk of overshooting, but also creates some opportunity, right? When the markets overshoot, that's when you get some good valuations to grab onto. But I do think, particularly when it comes to something like this, because it's a war and it's politically driven, there's so much uncertainty about how it turns out, right? This isn't something that we can kind of model out easily. We're modeling many scenarios now. And so, yeah, markets are going to overshoot in all directions. But I think the end of it for me is that I'm focusing now on what's the opportunity given the likelihood of a growth slowdown. Higher energy prices mean capital investment will slow down, probably hiring will slow down, GDP growth comes down, and eventually that does mean lower rates and lower inflation. It's just how we get there that's the question mark.
George, do you think it's appropriate to talk about stagflation light?
Well, I think there's risks. The stagflation risks have clearly gone up. Inflation pressures are mounting, and there's some concern about growth. And what we think is sort of the starting point of where the bond market sits today is really important. And so when we look at kind of the opportunity set that bond investors face as yields move up, that provides a lot of cushion to weather this volatility. And then when we look at the underlying fundamentals, the investment grade corporate bond market is still in pretty good shape. The securitized part of markets are in pretty good shape. And most importantly, municipal bonds are also in very good shape. So there's a lot of safety harbors in the market where you can harbor risk, weather the storm, and kind of clip your coupon as you kind of work your way through this.
Kathy, final question to you, because this is your last appearance on Real Yield on television before you retire. After 50 years in the market, initially as a runner at the Chicago Board of Trade, what is the single most relevant lesson that you've learned the hard way about investing?
Well, managing risk is the most important thing you can do in investing. Always know or try to game out at least the risk you're taking before you enter that investment, whether it's liquidity, whether it's volatility, whatever it is. Manage the risk, and the rest can take care of itself.
And that's exactly what's happening right now in March of 2026. Kathy, thank you so much. Kathy Jones of Schwab, congratulations to you.
Thank you.
Following your illustrious career, and George Bory of Allspring. Really appreciate both of you joining. Still ahead on Bloomberg Real Yield, a moment of interest. JP Morgan hitting pause on a debt deal. We're going to discuss why a certain multi-billion-dollar sale failed to win investors over and actually stoked credit fears. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. Now, a moment of interest, a key event that caught our eye this week. More and more firms are now warning of growing risks in private credit, with Morgan Stanley now seeing default rates hitting 8%. This week, we caught up with some executives to get their take on the potential stress ahead.
There is uncertainty, but as we look at the underlying health of the businesses that are underpinning these loans, we think the headlines are materially worse than that financial health.
They're not signaling a 15 or 8% default rate. They're signaling a bit higher default rates. And we would expect that. It's late in a cycle. We would expect that normally.
A lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where yet where we would be interested in buying them.
All right, let's get into this default debate and concerns around loans with our Bloomberg Reporter Roundtable. Emily Griffiths and Aaron Weinman joining us now. So, Emily, just kind of set the tone here with this Morgan Stanley report that private credit default rates could hit 8%. I mean, is this across the board or is this limited to problem areas like software?
The strategists at Morgan Stanley flag software because the reason, and this is what we've been talking about for a couple months now, is that alternative asset managers, private credit managers have been piling into software names over the last decade because there was this promise of a very predictable revenue stream. Now this idea here that artificial intelligence is going to disrupt that is kind of throwing everything into a tailspin. So they're warning 8% default rates, but they say it's going to be contained to the software names. The reason why this kind of made a stir, though, on the street is because software makes up a very large portion of private credit. If you look at BDCs, their estimate is about a quarter of BDCs. The exposure is to software. 8% would be about where we were during COVID. And then during the financial crisis, it was around a little bit over 10%. So it's not like a huge blow up or spillover into the broader economy, but it is elevated from where we are right now.
Fantastic context there. So let's talk about one of the deals, a debt deal with a software company, Aaron, and that is Qualtrics. JP Morgan halted a $5.3 billion debt deal for that company.
So yes, it's important to distinguish. They halted their pre-marketing talks. So the loan and the bonds haven't launched formally into syndication yet. But what's important to note there is they are currently, or they were, I should say, marketing the same to the same group of investors a deal for electronic arts, which is significantly larger. So when you've got two deals coming to the same group of investors across bonds and loans, what you'll typically find is in this current environment, you're likely to prefer one over the other. And electronic arts is certainly one that's finding a lot more favor with the investor community, whereas Qualtrics, because of its exposure to software, but importantly, the way that its existing loan is performing in the secondary market, you could probably argue that you can find more value buying their existing debt rather than taking a punt on a new loan from them right now.
Right, there are no bad bonds, there's just not great pricing, is what people like to say in the credit market.
That's right, and also I think the electronic arts financing is taking up so much of the oxygen and time of the market right now. I think the plan is for the banks to come back in a few weeks' time with Qualtrics, take the temperature of the market again ahead of potentially launching what I believe is about $5.3 billion into syndicated markets. But there's also just a lot of supply, right? Really quickly, I think Nexstar is another deal that's in market. Select Medical just got done. These are all billions of dollars in financing in a market that hasn't seen a lot of new money for quite some time. And beyond this, it's hard to know when the next wave of LBOs is coming because of the volatility.
Because of all the volatility. So that's where I want to go next, Emily. What are folks saying about the volatility, the elevated geopolitical tensions? I mean, it's a Friday and you see a lot of people choosing to go risk off because who knows what's going to happen over the next 2 days.
Yeah, but we saw the risk off, at least in the investment grade market, on Thursday and Wednesday as well. We haven't seen issuers come to market. And one reason could be because of this elevated uncertainty around the war in Iran. Look at what yields have done. Even just today, the 2-year up like almost 10 basis points. Traders potentially pricing in a rate hike for later this year. That's kind of throwing a tailspin, at least on the investment grade side, of who wants to come to market and when and at what price. Obviously, it could change next week. But at least in the last few days, there have been seemingly a little bit more jitters than there were even just a week ago.
How do things shape up for next week and the coming weeks?
So I think with high yield, I'll only speak to high yield, the investment grade is out of my purview, but in terms of high yield, you've got these transactions that are likely to price and launch next week. So I mentioned electronic arts, but one that's really high on the radar now is Nexstar. But the market's view is that they're all going to clear next week. That's the expectation. They might need to pay a little bit more to get it done because of the volatility you pointed out, Emily.
All right, fantastic. So credit market's working. It's just a matter of pricing then. Our Bloomberg Reporter Roundtable, really appreciate it. Emily Griffiths and Aaron Weinman. Now, still ahead on Real Yield, our Credit Roundtable. We're going to be speaking with Zachary Griffiths, head of U.S. IG and macro strategy at CreditSights, and Meghan Robson, head of U.S. credit strategy at BNP Paribas. This is Real Yield on Bloomberg.
Happy Friday. I'm Norma Linda. Let's take a look at your midday movers. Oil heading for another weekly gain as the war with Iran rages on. The Strait of Hormuz remains all but closed, but President Trump expressing frustration with military allies for not joining the Iran war or helping unblock the strait. The S&P 500 is at its lowest level since November. Also, shares of Supermicro plunging after the U.S. charged a co-founder with illegally diverting billions of dollars in NVIDIA's powered servers to China. He and two others allegedly sold the hardware to an unnamed Southeast Asian company and coordinated for its ultimate shipment to Chinese customers. Supermicro said it's cooperating with U.S. authorities. And shares of FedEx are up the most in 10 months after the company raised its full-year profit forecast. This comes as it signals that the plan to restructure its delivery network is gaining traction despite economic volatility. Those are your midday movers. I'm Norma Linda.
Coming up next on Real Yield, the auction block. We're going to focus more on credit as investors are scoring some of the highest concessions in years for new bond deals. Here in the U.S., concessions more than doubled in March compared to the prior month. And just checking on where yields are right now, the 2 and the 10-year, along with everything along the curve, is rising. The 2-year now at 3.87%, the 10-year at 4.36%. Those, by the way, are the highest levels since June, and it comes as oil prices have turned higher as well, with WTI now trading at $97 a barrel and Brent crude at just under $110 a barrel. More Real Yield coming up right after this. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we highlight the big credit issuance of the week. We start with U.S. high grade. The Novartis jumbo deal helped to drive this week's sales. Total volume, though, falling short of the $40 billion estimate for the week. There were no sales for the last 3 days due to central bank decisions and market volatility. Despite geopolitical tensions hampering new issuance over the past 3 weeks, this is already the third highest total for March on record. There has been just over $200 billion sold so far this month in U.S. high grade. And hyperscalers are a big part of what is driving those sales. Bank of America analysts recently increased their 2026 forecast for the group by a quarter to $175 billion. Hyperscaler spending on data centers this year is seen rising around 70% compared to last year to almost $700 billion. Now, speaking of credit, Alex Altman from Barclays says even with all the concerns circling around the sector, there is reason to be positive.
And ultimately, are we going to have a credit cycle at some point in the future? Yes, we probably will. That's just inevitability of the way the world works. But does that necessarily mean that it's all doom and gloom? The US economy is sitting on the lowest private debt to GDP in the past 25 years. The banks are the best capitalized they've been in a very long time. We are in, as an economy, a better place to handle a credit cycle than we were at any point for the past 2 decades.
Let's dig into all of this with our credit roundtable. Zach Griffiths is head of U.S. IG and macro strategy at CreditSights, and Meghan Robson here with us in studio, head of U.S. credit strategy at BNP Paribas. Thank you so much, both of you, for joining us. And we have, of course, seen corporate bond yields follow Treasury yields higher. For instance, junk bond yields, Meghan, now at a 9-month high, set for their 4th straight weekly gain, which for anyone keeping track is the longest in 2 years. And then you look at spreads, both investment grade and high yield, both widened after the start of the war, but have come off their widest levels. So I'm just going to start big picture. Why is this market so resilient? And how much wider do you think spreads should go to reflect all the growing risks that are out there?
So, Scarlett, you raise perfect point that spreads still remain very tight, but the widening is actually, I think, more than people might appreciate. when you look at how tight we started. So think back in January, IG spreads were 70 basis points. They widened to a 90 basis point level. So historically still tight, but as a percentage, that's pricing in a lot more risk premium. I think one reason that we've been so stable is related to investor positioning. So we have a credit positioning indicator, and it shows that investors are actually underweight risk right now. They're short the market, they're underweight beta, and so that means there's actually scope to add risk on any good news, and also explains why we haven't potentially moved wider, because there wasn't as much de-risking that needed to be done as we saw some of these headlines.
Zach, what do you think?
That's interesting. I feel like most of the conversations that I've had, clients have been fully invested and remain optimistic in a variety of scenarios. We paint a picture of slower growth, wider spreads, and lower yields. And we've gotten some pushback on that, mostly because I think clients are skeptical yields are going lower. While credit spreads remain historically tight, there's a lot of comfort with the all-in yield level, and that seems to be driving investor behavior. It'll be interesting to see how the recent move higher in yields either reaffirms that view or calls it into question. We think the recent move you've seen ultimately probably proves to be an attractive entry point to add duration, but catching a falling knife is certainly a fool's errand, at least historically.
And in terms of the pickup in high yield fund outflows, Zach, how worried should we be about that? It's now the largest in 11 months.
Yeah, I think that's a sign of a shift in sentiment, at least across asset classes. I think when you look at what's going on in U.S. investment grade, inflows remain fairly robust, but we are starting to see a little bit of a questioning of allocation to the higher yielding and leveraged loan market in general. And so that's kind of consistent with our view for moving up in quality in this type of uncertainty that seems to be coming from all sorts of directions. And in terms of the war in the Middle East, only seems to be worsening in terms of the prospects of this becoming a prolonged situation.
Meghan, traders are now starting to price in the odds of a rate hike. The odds are, not certain; they're pretty long, but that would be bad news for weak borrowers that need to refinance in the coming weeks and months. How would it impact investment grade?
It could be bad news. Our baseline is that we actually have the Fed on hold for most of this year. So yes, we've come a long way since the end of 2025 when the market was pricing in a couple rate hikes, and now, as you point out, some rate cuts, and now some probability of hikes. But we think the bar for either a cut or a hike is pretty elevated. And so we see that as a low risk. I think it really depends on the magnitude of hikes that we end up seeing and how high inflation expectations really are. If we just have 50 to 75 basis points of rate hikes, I think that would be manageable for leveraged finance issuers. That's exactly where we were in August of 2025.
So let's talk about new issuance as well. And something that I mentioned before we went to break. More than a third of the business days, Zach, in March have featured no investment grade deals in the U.S. And it's a similar picture in Europe as well. And for those companies coming to market, we see credit investors are scoring new issue concessions. How long do you think this concessionary environment lasts for?
We think this could be the normal operating environment going forward, Scarlett. And if you see what's really been driving the uptick in these new issue concessions, technology is a big part of that. And that's been one of our core views coming into this year, is all of that supply to finance the AI capex. You were just mentioning a hyperscaler call in terms of capex spending from B of A. Our call at CreditSights is $750 billion for this year alone. And so that's certainly an incredible amount of spending. It's not coming just from cash flow from operations. Of course, these companies do generate a lot of cash. This greater need to rely on the bond markets, we think, overall becomes a technical overhang to a market that has over the past couple of years benefited from a very strong technical backdrop with a lot of cash coming into the asset class, chasing somehow seemingly not enough bonds. We think that dynamic shifts, and you're starting to see early signs of that in the primary market.
How high are investor cash balances right now, Meghan? They have money to put to work, but what level of spread are they waiting for to come back in?
It's a great question. I think it's not only a question of valuations and where they come in, but also the risk backdrop. So do we see some of the geopolitical headlines start to abate? What is the resolution around geopolitical conflict? I think that's a big question mark as we head into April. I think if we see some resolution there and oil prices come down, that would give investors more confidence to put cash to work. But from our read, I think there are cash balances out there. Investors are on the sidelines waiting for some clarity around the issues that we're facing now.
What's the best way to position for all this uncertainty that we're seeing? Is it as simple as long anything energy and short consumer names because the rising oil prices is a tax on consumers?
It's the investor positioning is a great question. I was at our BNP Paribas Open Summit last week, and we're debating this with investors. I think one recommendation that really resonated was an overweight to U.S. over Europe. When you think about rising energy prices, the U.S. is much less exposed as a net exporter of energy compared to Europe. And if you look at the sector distribution across credit markets, there's less energy intensive sectors in the U.S. compared to Europe. So we like that rotation right now.
Zach, is investment grade developing into a preferred haven here? Because they're seen as better than treasuries in some cases, which is not unlike some emerging market companies that have steady cash flow and often trade at tighter spreads to the sovereign. I wonder if we're going to see more companies here in the U.S. trade at negative spreads to treasuries.
That's not our base case, Scarlett. And if you look at the fund flows, even over the past couple weeks, you have seen stronger demand, at least through ETFs and mutual funds for sovereigns relative to corporates. Now, of course, you've seen yields sell off quite a bit. And so in an environment where we have prolonged concern about the U.S. government and borrowing costs, we ultimately think that that is not only a problem for the U.S. government, but for U.S. corporations as well. Maybe that's hedged a little bit by some of these large multinationals that generate cash flow all over the globe. But ultimately, we don't think you're going to see a huge shift to many names without factoring in various other structures in the bonds trading inside of treasuries.
And we can't go without talking about private credit, Meghan. All the noise that we're seeing among BDCs and private credit, at what point does it bleed into public credit, or does it actually help public credit because it's public credit, IG is seen kind of as a haven?
We really think in order for it to bleed into public credit, we need more evidence that the fundamentals of some of these private credit companies are actually deteriorating. I think a lot of the headlines have been about redemptions, and there's fear around AI disruption in software. But coming out of earnings, we've actually seen still very resilient EBITDA, earnings growth, and forecasts from these companies. So I think that picture would really have to change to see more of an impact or a tightening of credit conditions in public markets.
All right, Meghan Robson of BNP Paribas and Zach Griffiths of CreditSights, really appreciate both of you joining us. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcast hosted by James Crombie on the Bloomberg Terminal and wherever you get your podcasts. Still ahead, a moment for munis. More New York City commuters are hitching rides on the subway. The real reason behind the transportation shift is next. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. Oil heading for another weekly gain as tensions with Iran continue, and the Strait of Hormuz remains all but closed. President Trump has also expressed frustration with allies for not joining the conflict or helping to reopen the strait. Meanwhile, U.S. stocks are declining for a third straight day as hopes for a quick resolution fade. The Nasdaq 100 is sitting at its lowest level since November. Major tech companies like Microsoft, Meta, and Alphabet are weighing heavily on the broader market amid a risk-off tone. Meanwhile, Planet Labs is jumping for double-digit returns after the satellite imaging firm reported revenue for the fourth quarter and a 2027 revenue outlook that beat the average analyst estimate. And shares of Nexstar are rising after the company announced plans to raise billions through new debt offerings. The proceeds, along with cash on hand, will be used to pay down bridge loans tied to its acquisition of Tegna. Meanwhile, Paramount's guidance is rising after CBS News said it will cut about 6% of its workforce and shutter its radio division as it adapts to changes in the news industry. Those are your midday movers. I'm Nora Melinda.
It's time now for a Muni Moment, and we actually have two moments for you this week. For that, we've gathered two of our Muni reporters, Michelle Kasky and Aaron Hudson. Welcome to you both. Thank you for coming on Real Yield. Michelle, let me start with you and New York City, because there's a major subway expansion project here in this city. What's the status of that? Because it always involves borrowing money.
Definitely. It's along the Upper East Side. It's the 2nd Avenue subway, which what they are working to do is extend it from 96th Street all the way up to 125th Street in Harlem. And this will really help out residents in the East Harlem area that have been waiting for mass transit for decades.
Yeah, it's a subway desert out there. So why is the Metropolitan Transportation Authority, the MTA, then suing the federal government over funding?
Well, the issue is that the federal government under the Biden administration promised about $3.4 billion for the project. And since October, the Trump administration has put reimbursement money on hold. So MTA has not been getting these reimbursement payments, and those total about $60 million so far. And the MTA is saying, look, we got to take you to court to get this money.
Has construction started on it yet? Where are they with the actual project?
Oh, definitely. Construction has been ongoing for a while, so that hasn't stopped. Okay. So as of now, the work is still ongoing. The question is, at what point might this actually slow the project down, delay it, or stop it entirely?
Yeah, like what we've seen in New Jersey with the Gateway tunnels as well. Definitely. When we talk about subway ridership, we've actually seen ridership increase in 2025 from 2024. We also, of course, know that that happened at the same time that congestion pricing was introduced. Is there a direct cause and effect there?
Yeah, congestion pricing did have an impact on ridership. It did help to encourage some drivers to get out of their cars and either get on a bus or a subway to get into some of the busiest parts of Manhattan. And so we did see an increase in subway ridership in 2025, about 7.7%. Now, granted, naturally, this subway ridership, it inches up every year, it increases every year, but that new toll did help to persuade people to take mass transit.
Yeah, still a far way off from what we had seen before the pandemic.
Definitely.
In terms of the congestion pricing, that is still on, despite the White House's threatening to end it or take some action to put a stop to it.
That's right. It's still ongoing. It's still happening, the toll, and the Trump administration has tried to end it. Earlier this month, the MTA got a ruling that they wanted from a federal judge saying, look, the toll is lawful and it's still in place.
All right, Michelle Kasky, thank you so much. I'm going to check in now with Aaron Hudson, who's written a story about a Michael Milken-backed private school tapping the muni market for a new campus, which of course got my attention because he's the pioneer of junk bonds, and we're talking about the muni market as well. Tell us a little bit more about this deal.
Yeah, so this deal is from the Milken Community School, which is a co-ed Jewish day school in LA. Tuition there is going to be going for about $57,000 starting in September.
That's a bargain if you're in New York, but go on.
Yes, the average nationally is $50,000 for a private school of this caliber. And so the reason they're coming to the muni market is they're looking to borrow funds to expand their campus. They're doing a big expansion. They're going to triple the size and build some new facilities, including an innovation lab, some specialized classrooms for subjects like architecture, fashion, and amenities like a golf simulator are all part of this expansion.
It very much feels like these private schools are in an arms race to increase their extra perks that they offer students and their facilities. Is taking on debt this way risky for a school like this?
So it is absolutely becoming an arms race, and part of the reason why they're doing this is because of the demographic pressure that all schools are facing. But it's particularly acute for private schools where, there is very pricey tuition that parents are paying. They want to see top grade facilities for their children. In terms of the risks, so this type of muni bond is very unique. It's backed by fundraising, so the school's ability to fundraise. So the school's connections to Michael Milken, for example, whose family foundation has provided financing over the course of the school's history, is something that investors would really look at, because you want to see that the school has a strong donor base, because that's what's going to be repaying the bonds. A typical school bond is backed by property taxes by comparison. So the world of the private schools in the muni market is quite unique. And it's one that investors look closely at. But it's worth noting this school is investment grade rated.
That's going to make admissions time really interesting, because there's a lot to consider there if it's going to depend on fundraising. How are investors viewing these bonds overall?
So, just to go to this school in particular, they're fundraising. So they've already got quite a bit of fundraising already in hand.
Got it.
They've already raised $110 million. About half of that is in cash. Another half is in pledges over time. So in general, though, these are a unique type of structure. So investors definitely look closely at that. So it's a consideration.
All right, well, you will keep us up to date on all the developments there. Thank you so much, Erin Hudson, and of course, again, to Michelle Kasky for our Muni Moment. Now, still ahead, we've got the final spread. It is the week ahead as central banks around the world assess rising inflationary risks. We will tell you what to watch for. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the final spread. The week ahead, coming up on Monday, 3 big events kick off. We've got Sarah Week in Texas, the China Development Forum, and the Milken Global Investor Symposium in Hong Kong. On Tuesday, Anthropic heads to court as the AI firm fights to reverse its designation as a supply chain risk by the U.S. Department of Defense. Plus, the Hill and Valley Forum kicks off in Washington, so look for headlines from those events. Wednesday, ECB President Christine Lagarde delivers remarks. Starbucks hosts its annual shareholder meeting, and we will get earnings from Chewy and Jefferies. On Thursday, G7 foreign ministers will be meeting in Paris, and former Venezuelan leader Nicolas Maduro will be returning to court. And on Friday, we get the release of University of Michigan consumer confidence, as well as earnings from Chinese EV maker BYD. For my final thought, central bank leaders around the world are weighing the inflationary impact caused by the conflict in the Middle East. Take a listen.
A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices.
Higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
By the next time we meet, a lot will have happened, and I can't predict what. I can't possibly, none of us can predict what it will be, but it is a very volatile situation.
And as a result of those comments, along with the overall environment, some traders are now pricing in rate hikes around the world. Our Mike McKee joins us once again. Mike, it sounded like those central bankers were kind of saying the obvious and at pains to not say too much more.
I think the governor of the Bank of England probably put it best when he said, next time we meet, a lot will have happened, because we've had it happen in just the last couple of days since some of these banks have met. But we did see a couple of them, like the European Central Bank and the Bank of England, sort of tee up the idea of rate increases coming up. Jay Powell sort of downplayed that idea in the United States, even though some people are now pricing it into Fed funds futures. Bank of Japan I leave out because they were going to raise rates anyway at some point. But the other two, they are going to have much greater inflation problems than us because we have oil and we have natural gas. And so our costs are going to be a little bit lower and more spread out. Theirs are going to be much higher, especially now with natural gas, with what happened in Qatar.
Yeah, absolutely. With that LNG factory really not in operation at the moment. The U.S. is a net oil exporter. Europe and the U.K. import oil, so that's why they see the impacts much more quickly. Do those central bank officials talk once again? I mean, maybe not the leaders of the central banks, but other officials. Are they going to be adding to the noise?
There'll be some around the world, but most of the people around, most of the other central banks around the world are what you would call takers rather than makers. They're going to have to deal with the interest rate situations as determined by the largest central banks. And if you're seeing central banks raise rates, then you may be in the same boat, both because you have an inflation problem, but also because of your currency, the currency effect if you don't. So I would imagine that a majority of the central banks around the world are at least going to be looking at the idea of raising rates. And all this will depend on how long this whole conflict goes on.
Yeah, the one thing that we don't know. Bloomberg's Mike McKee, thank you so much, our international economics and policy correspondent. And from New York, that does it from us. Be sure to tune in to Bloomberg Real Yield next week, same time, same place. This is Bloomberg. Balance of Power is up next.